Hello everybody. This morning I'm going to comment what is happening on US equities, which means a death cross. We'll also start with a view on what's happening on European markets with renewed selling pressure yesterday, a very bearish day, and back to new year lows. And then I'm going to end with what's happening on stock sectors, so in Europe, on European sectors. So first of all, if we start with the Euro Stock 50, as you can see, the Euro Stock 50 went significantly lower yesterday, broke below the lower part of a triangle formation, which was forming since 2 months. This is a quite negative technical event, of course, and but the index hit an important Fibonacci support, which is a 61.8% retracement of the entire 2016-2017 uptrend. So you can see this move. And I mean, if I look at what happened the previous time we saw important Fibonacci support, so you can see it here or here, usually what's happening is that you break below this Fibonacci support because there are stop loss orders activated, which I think is what we saw yesterday. And after that, very often you have the start of a technical bounce. So bulls are capitulating, are getting stopped when the key technical levels are breaking down. And after that, you have a start of a relief rally. So contrarian investors are jumping in and they push the market upwards and trigger an invalidation of the bearish signal. So this is what we saw, for example, in late March. We also saw this type of pattern, although it was less significant in October, in late October. So that's once again quite likely today. So a capitulation move yesterday and possibly the start of a relief rally, which is in line with the Christmas rally that usually starts around the 14th of December. Anyway, as you can see, a market that is still trending downwards. So all we can expect at this stage is start of a technical bounce, relief rally, force breakdown. But in any case, we can expect the start of a significant bull market. Another quite interesting event, if you look at the point and figure chart, I mentioned this downside target on the point and figure chart, I think it was over the summer. So midterm risk was 30.70 on Euro Stock 50. As you know, this target has been hit yesterday. So once again, Fibonacci support hit at around 30.70, downside target hit on point and figure chart around this level. So for me, the conclusion is not really bearish here. I think that someone who was short on European equities and had targets in this area should now reduce risk and book profit. If you are not short, if you are still long on the market, I would hold position so far because I think there is an excess right now. Something quite important as well. So we saw a breakdown, a significant breakdown of the Euro Stock 50 yesterday, but the S&P 500 is still holding above its key technical support. So the key technical support is around 2600. This level is holding so far, and I think it will hold till year end. So this view is not invalidated. The bad news is that we saw the failure to break a key Fibonacci resistance slightly above 2800. So this was at the start of the week, but I think we will continue to see the S&P trading sideways between these two boundaries, so between 2600 and 2800. I think this will continue till year end. Yeah, something quite important. So I was mentioning in the introduction a death cross. So you can see it here, which is a bearish crossover between the 50 and the 200-day moving averages. This is a quite rare signal because the previous buy signal, so the previous golden cross, was triggered back more than 2 years ago. It was in April, May 2016. So 2.5 years of bullish signal, which is a very good call. However, I'm really, I mean, I'm not focusing too much on this signal. First of all, because moving averages are lagging indicators, which means that if we have a sell signal right now on this indicator, it's because the market is already down sharply. So usually it's not a good timing indicator. It's even a bad one. As you can see it here, so I showed you the two previous death cross, and you also have a golden cross here. Very often the signals are coming late, which means that we have a sell signal after the decline and a buy signal after the rise. And usually what's happening is that, I mean, it's not a question of days, but usually the signal comes near a low for a sell signal and near a high for a buy signal, and you start to see a reaction after this signal. Which means that it's not because we are selling a death cross signal right now that the market's going to fall sharply. I even think sooner or later we are going to see a relief rally starting on this market. But you have to be very cautious about this relief rally because the medium-term outlook is showing signs of weakness. Obviously, that's what the moving average are telling us right now. If we look at Eurostock 50, so death cross back in February, the signal was pretty good because it was the start of the correction, or the medium-term correction, and we see that since then the market is going down pretty significantly, down around 10% since the sell signal. But as you can see once again, this was not a good market timing at all. The market moves a bit lower after the signal, then start a 10% relief rally. So a few months after the signal, the market was up, not down. Anyway, medium term, you can see that the trend is still quite negative right now. So once again, all we can expect is a false breakdown. I mean, the most bullish case would be a false breakdown below 3100, but I mean, it's much too early to expect a significant bullish reversal. On the upside, keep an eye on 3250, which is a key technical resistance. A few comments before ending this video about what's happening on the cyclical part of the market. So this is an update of my ranking matrix on European stock sectors. As you can see here, after the monthly rating changes, which were updated at the start of the week, the matrix is showing something unbelievable right now, with most cyclical sectors in the worst part of the ranking system, and most defensive sectors in the best part. This is something quite amazing because it shows that the market is extremely bearish in terms of sector allocation. Most fund managers are now overweight on the defensive part of the market, healthcare, food and beverage, media, etc., and are massively overweight. They were washed out if they were overweight on cyclicals. So this is a quite dangerous situation right now because it shows that the most fund managers are now very anxious about the possibility of technical bonds of the cyclical part of the market. And this is the type of market conditions that are extremely difficult to manage because if we have at any point technical bonds of the cyclical part of the market, and we will have this kind of technical bonds, it will be very steep because fund managers are probably now underweight on this part of the market and will panic if this sector bounce back. So I think the volatility of the sector rotation will remain very high. Markets are difficult, and they will probably remain difficult to catch because the market's going to whipsaws. And if we have any technical bonds starting after yesterday's capitulation move in Europe, I think we are going to have very steep moves. Have a nice day and a good weekend. Bye.